Thank you everyone for taking the time to be with us this morning. I will jump straight into the presentation in the interest of time. And this morning I'll be talking about the market outlook. But before I start with the market outlook, I want to quickly just look back at what happened over the last few months to get an appreciation of what has happened in the markets. So let's start with the equity markets. We'll cover equities, bonds, as well as other asset classes just to see how they perform so far this year. So equities has had a roller coaster ride. I mean, stock markets, global stock markets based on the MSCI Global Index fell 32%, very sharply because of COVID-19 the first 3 months of this year, and then subsequently rebounded by almost 50%. So it's been a spectacular rally. But having said that, the rally has primarily been driven by technology stocks, to some extent healthcare stocks. So it has not been a very broad-based rally. There are some sectors that have really underperformed. In fact, several sectors have underperformed, and the star performers have really been technology and healthcare. Now, if you look at the global bond markets, once again, looking at the global bond market index, you can see that global bonds as well, because of COVID-19, fell by 4%. Not as much as equity markets, but nevertheless, it fell 4%, and then rebounded by 10%. So recouped its losses and went even higher, right? So I think investors saw bonds as a way to protect their portfolios, and I think it makes sense. You should have a spread of assets in your portfolio, including equities and bonds. Once again, the 10% rebound in bond markets was not broad-based, just like equities was not broad-based. In the case of bond markets, it's primarily focused on IG bonds, or what we call investment-grade bonds, because the flight to safety resulted in these bonds doing very well. And the high yield bonds, which are more risky, have lagged the market. So once again, there could be some opportunities in that space. Now, if you put all the asset classes together, what you see is that, gold has been really the star performer so far this year, up 27%. And then, of course, technology stocks have up also very, very sharply, 25% or so. And then followed by, bond markets up 6%, and then equity markets up 1%. So the star performer has really been gold. Gold has done exceptionally well, and we remain relatively positive on gold for the medium term. Technology as well, it's done exceptionally well. But like I said, there could be some rotation out of the tech sector into sectors that have underperformed so far this year. Now, let's just start with COVID-19 and its economic impact. It's been a very, very significant economic impact, as I will share with you in the next 2 slides. Okay, so the first slide, you can see that the IMF is forecasting that the world economy will decline by 4.9% in 2020, much worse than the global financial crisis of 2008, 2009, when the global economies only fell by 0.1%. So the current crisis, because of COVID-19, is clearly more severe in its economic impact than the global financial crisis. And it's not just the IMF who thinks that. The World Bank as well expects global output to shrink by 5.2% this year. They're actually more negative than the IMF. And in the case of the United Nations, they expect the pandemic to wipe out $8.5 trillion in global output, which is almost equivalent to 4 years of gains in terms of the global economy. The OECD is the most negative. It expects global growth to decline by 7.6% in 2020. So you can see these supranational organizations, which are relatively independent, what they're saying is the impact of COVID-19 on the global economy is very, very severe compared to what you've had over the last few years and even decades. Now, other data to just give you an idea of the impact of COVID-19, US economy slumped by 33% in the second quarter of this year. It is not a typo. It is 33%, minus 33%. Those are the kind of numbers that you see during a Great Depression. But that's the kind of numbers that the US economy recorded in the second quarter. The US economy lost 12 million jobs in the first 7 months of this year. That's equivalent to all the jobs the economy created in the last 5 years. And the Federal Reserve in the US is forecasting that the economy will grow by 6.5%, or rather contract by 6.5% this year. And they see a long, slow road to recovery. China's economy declined by 6.8%, right, in the first quarter of this year, which is the first economic contraction in China in 30 years. Of course, the economy has rebounded slightly, but nevertheless, the Chinese economy has not contracted for the last 30 years, contracted for the first time in the first quarter of this year. The EU economy, European Union economy, okay, is actually down by 12% so far this year. Yeah, the EU economy contracted by 12% in the second quarter of this year, which is the sharpest decline in the last since the 1990s. And the UK economy shrank by 20% in the second quarter of this year, the largest contraction among the major economies. So that gives you an idea of the impact of COVID-19, and you can see the impact has been very, very severe. Now, if you look at earnings, it is not just economy that has declined, but it's also earnings. Earnings declined by 29%. So COVID-19 has not just impacted the global economy, it's also impacted company earnings very significantly. Now, despite the weak economic data, you can see that markets have rebounded very, very sharply, which surprised many investors. And, global equities are up 49% from the March low this year. US equities have been a star performer, up 53%, Europe up 45%, Asia up more than 40%, and Japan up 30%. So the question that, investors have at this point in time is, are the markets disconnected from economic reality? Economies don't appear to be doing well, but the markets are just, soaring. Now, if you look at COVID-19 relative to past crises that have gone all the way back to the 1970s, the oil crisis, and you can see that, the swings in the market have been very quick and very sharp. Under COVID-19, the markets fell 34% in 1 month and then rose 49% in 4.5 months. So the movements have been very short and very sharp, much crisis, which has left investors, bewildered as to whether this rally can continue. I'll try and address the question in the coming few minutes. Now, what's behind the recent rally? Let's understand the reasons before we talk about the outlook, and I'll summarize it as 3 factors: hope, fear, and liquidity. So what's behind the rally? I mean, these are the key factors. I think we are starting to see green shoots of recovery. Some positive economic data starting to emerge that has inspired confidence. The reopening of economies and the possibility of a vaccine have also inspired confidence. We've seen extraordinary monetary policy and fiscal policy. Again, this has given confidence to investors to jump into the markets. And of course, investors are fearful of missing out on the rally. In other words, what we call the FOMO effect. The rally has been so quick and sharp. Some people think better jump in before we miss the rally, and that has also pushed the markets even higher. And finally, of course, there's a huge amount of liquidity on the sidelines, looking for a home amidst low interest rates, and that's also contributed to the rally in the markets. I'll elaborate on some of these points. So first of all, you can see that the red line is the economic surprise index, and you can see economic data in the last few months have surprised on the upside. And because it's surprised on the upside, that has been a fuel for the markets. It's helped markets to hit even higher, right? And so the green shoots of recovery I talked about is encapsulated in this chart. It tells you that data is surprised on the upside, and that has helped markets to rally. If you look at this chart, it gives you an idea of the global economy. The Global Composite Purchasing Managers Index that includes services and manufacturing. It fell very sharply in March and April, but it's rebounded very sharply as well. So again, inspiring confidence that perhaps the global economies are out of the woods. Now, the hope for a vaccine, you can see lots of vaccines under development throughout the world, right now. And investors are hopeful that perhaps when a vaccine is found, it will be the silver bullet. And again, this has inspired confidence and caused markets to rally. And of course, we've seen unprecedented fiscal policy support. Globally, you have about $13 trillion in fiscal stimulus unleashed, totally, right? All over the world, 13 trillion, that amounts to about 16% of world GDP, which is very, very sizable. Okay, nothing like what we've seen before in the last few years, even decades. So we've seen unprecedented policy support from governments, and that has again inspired confidence in the markets. And if you look at the fiscal policy support, the taller bars tell you the fiscal policy support right now. The shorter bars tell you the fiscal policy support in 2008, 2009 during the global financial crisis. And you can see that, the response from governments now have been substantially more significant than during the global financial crisis. So again, I think, this is what we are seeing in the markets. Because of this, the markets have also rallied. Now, if you look at central bank action as well, it's been unprecedented. Central banks have unleashed unprecedented policy, huge amounts of liquidity. They've been very aggressive in cutting interest rates, injecting liquidity, the most aggressive being the US Federal Reserve. And again, central banks are saying we'll do whatever it takes, and that has, given confidence to investors. And you can see money supply growth has exploded. The Federal Reserve has, unleashed unprecedented policy, and it's captured in this chart. It tells you that money supply growth has really exploded. It's helped the real economy. It is also helping the stock markets. Now, despite all that good news, it may be still too early to assume that the worst is over, and I'll tell you why. Okay, firstly, we go back to the Spanish flu between 1918 and 1920. This was the big pandemic that we saw. probably equivalent to COVID-19 or something that's comparable. I would say the Spanish flu was even worse because it killed 50 million people, right? And you can see that from this chart, right, the Spanish flu came in 3 waves. The first wave was a relatively small wave, and then you saw a big wave that was almost 6 times the size of the first wave, and then we saw a third wave. So typically pandemics like this never come and go very quickly. They will stay with us and they will come in waves. And this is exactly what we're seeing right now. We're seeing COVID-19 cases still very high. Yes, at the peak at the end of July, total number of new cases worldwide was close to 300,000 in terms of COVID-19, but that has come down only slightly to about 280,000 cases worldwide. So in some jurisdictions, things have improved, but worldwide, total number of cases are still very high. So COVID-19 remains an issue that investors worry about. If you look at the US, clearly things have improved. The COVID-19 figures in the US have come off quite significantly. They had as many as 70,000 COVID-19 cases at the peak just a few weeks ago. That has come down to about 40,000 cases. So quite a bit of improvement, but still at 40,000, that's significantly higher than what they had at the onset of COVID-19. So COVID-19 remains a problem even in the US. In Asia, you see countries like Indonesia, Philippines, and India struggling, especially India. Just a couple of days ago, India hit a record high in terms of COVID-19 cases. So COVID-19 is still here to stay. And if you look at these charts, what they tell you is that the second wave of infections in some countries like Japan, Vietnam, and Australia that did a good job in containing COVID-19. Second wave has been bigger than the first wave. So recollect what I showed you about the Spanish flu. Second wave was significantly higher than the first wave. So you're seeing that play out in some countries. Hopefully this does not become quite pervasive. And COVID-19 is not just it started in China, went on to Europe, went on to the USA. Now it's moving on to Latin America, South America, and even Africa, right? So it's really spreading. You're seeing new epicenters starting to approach. So COVID-19 remains a fixture, remains an issue, although things have improved in some jurisdictions. Now, markets are hopeful that a vaccine will solve all our problems, silver bullet. But in reality, if you look at history, going back to, as far back as 1880, you can see that vaccines take decades to develop, decades, in some cases. Here we are talking about a vaccine being developed in months. Of course, huge amount of government support going into the development of vaccines. But the question becomes, are these vaccines safe? Are they effective, right? And I think globally, there's no clear alignment in terms of what constitutes safety and what constitutes effectiveness in terms of tests. So still playing out, although Russians claim that they have a COVID-19 vaccine, I think nobody totally believes them. Some countries have accepted the vaccine, but people are worried about the safety issue, right? So I think even if a vaccine is found, it will not be a straightforward issue. Some countries will still want to perhaps test it even further. In some cases, vaccines will not be available to everyone so quickly. It takes time to produce a vaccine, right? So the impact of the vaccine may only be felt in the coming years. So it will not be a silver bullet that fixes the problem immediately. Now, COVID-19 is a medical crisis that has morphed into an economic crisis, and the fear is that it could develop into a financial crisis, especially if we see corporate bankruptcies starting to increase. In the US, we're keeping a very close eye on the corporate bankruptcy numbers. You can see in 2008, 2009, the numbers spiked up, and that caused the financial crisis, in the financial system. But this time around, it is going up, but it's not as severe as 2008, 2009. So that's the good piece of news. But of course, if COVID-19 drags out and there's an economic fallout and more companies close shop and there's defaults, then clearly then it could morph into a financial crisis. So we are keeping a very close eye on this chart. Now, the other issue is, of course, the US elections in November. And what you can see is essentially that, the US electorate have a very unfavorable opinion towards China. So what you can expect in the run-up to the November 3rd elections is a lot of China bashing. Not just from Trump, to some extent even from Biden, because they have to play to the tune of the popular demand. And it is not just a Republican or Democratic problem. You can see that Republicans are more negative towards China, but the Democrats are also very negative on China. So they're going to use this as political capital, to play up the China bashing, and that could, make markets a bit nervous. Now you can see in this chart that Donald Trump's approval rating has plunged because of his handling of COVID-19. And right now, the polls and the prediction markets are forecasting a clean sweep for the Democratic Party. In other words, Biden wins the elections, the Democratic Party retains control of the House of Reps, and the Democratic Party regains control of the Senate. So in other words, a clean sweep of the government. Now, is that good news or bad news? It depends, because with Trump, I think Trump cut taxes, increased spending, pressured the Federal Reserve to keep interest rates low, pressured OPEC to cut oil prices. That's been good for the markets. Markets have done very well under Trump's watch. The rest of the world, of course, is suffering politically, but the stock markets have done very well. Now, Biden is somebody who is going to, may not be very positive for the markets, because he's talking about increasing the corporate tax rate from 21% to 28%. He's talking about tighter regulation for the financial industry, for the energy sector. He's talking about breaking up the big tech names in the US. So be careful what we wish for. I mean, Trump, if he loses elections, may not be necessarily positive for the markets. The markets might start focusing on Biden's policies, especially if it's a clean sweep, then he can do whatever he wants, and the markets could turn nervous. But right now Biden is ahead in the polls, right? But if you cast 2016, Hillary Clinton was also ahead in the polls, ahead to Donald Trump at this stage in August of 2016. But by the end of 2016, okay, the tide had turned in favor of Trump. So it remains to be seen. We still have a few more months to go. Remains to be seen whether Biden will retain his lead over Trump. I think the critical things will be the presidential debates that will take place in September and October. That will set the stage, for voters to decide who they want to vote for. So the game is not over. Biden may not have won. It remains to be seen. The coming months will tell whether it will be Trump or Biden. Now, if you look at the P ratios for the markets, valuations right now in terms of P ratio are not cheap, right? I mean, they are now more than 3 standard deviations above the 5-year average. So that's relatively expensive. But if you don't use P ratio and use other valuation measures like equity risk premium or what we call the yield gap, which are based on interest rates, and because interest rates are very low, there's a justification for equity markets to still hit even higher, to have even higher P ratios. So in an environment where rates are very, very low, that supports higher valuations for equities. So even 3 standard deviation, yes, it's expensive. You've got to be careful. The gains going forward will not be as significant, but it may still hit even higher equity markets, but probably not at the same pace that we saw in the last 6 months. Now, analyst forecasts, are analysts too optimistic about the growth forecasts? You can see over here that most of them are quite negative for 2020. That's expected, but 2021, they're all expecting a huge rebound in earnings. Is it really going to be a huge rebound in earnings? Because, economies are slowly getting back on their feet. We're not seeing a V-shaped recovery, but analysts are forecasting a V-shaped recovery in earnings. Are they being too optimistic? So next year, when the earnings comes out, will they be disappointed? And then, will markets respond to that? That's a risk factor. But here's the good news. Huge amount of money on the sidelines. This is a chart of US money market funds. This is where you park your money temporarily until you decide what you're going to do with it. And there's $5 trillion in US money market funds, which is almost a record high. So lots of money on the sidelines looking for opportunities. So if markets pull back sharply, some of this money could go to work and help the markets to rebound and not stay down. Similarly, US personal savings rates, and this is a picture quite similar across the world. Very, very high personal savings, $5 trillion in personal savings in the US, almost a record high. Again, this is a lot of firepower on the sidelines, liquidity firepower that could provide support for the markets and so provide a floor for the markets. If you combine the money market funds and the savings, you put them together on Wall Street, it accounts for more than 50% of S&P 500 market capitalization. So it is massive. The amount of liquidity available right now is massive, and that is a source of support for the markets. And if you look at this chart, what it tells you is that typically when economies recover from a recession, the rally can go on for a few years, and there could be more upside. So right now we're in a recession, right? We've had probably 2 quarters of negative growth in many, many cases. And as the economies recover, what this chart tells you is that don't give up hope. Equity markets could respond positively to that, post-recession recovery. So let me summarize. Number 1, COVID-19, the second wave is still playing out. We're still not sure how bad it's going to be. Let's watch and wait. We've seen lockdowns in Victoria State, Melbourne. We've seen lockdowns in Auckland. Hong Kong has been, tightening up. So several countries have been, now going backwards and, dealing with the second wave. Now, even if economies reopen and restrictions remain in place, right? It's not a free format, right? I mean, you still have to put on your mask. Restaurants can only have half can only be half occupied. All seats can be taken up. You've got to have a big gap between the tables. So business will not go back to 100% of what it was before COVID-19. The recovery will be slow and gradual. And of course, the other risks that you want to bear in mind are risks like US-China tensions, US elections, and the risk of corporate default. So the course ahead is still unclear. Uncertainties remain. Invest carefully. We are not suggesting you don't invest in them, but invest carefully. Don't get carried away by the rally. As I said, if a vaccine is discovered by the end of this year or maybe first quarter of next year, put aside the safety element. The markets may respond quite positively. So you don't want to be caught wrong-footed, being completely out of the market as well. But keep a diversified portfolio. Don't fall in love with technology. But the message I have is basically keep a diversified portfolio. Have a combination of equities and bonds in your portfolio. Buy gradually. I think it's important to spread your investments out gradually over time. And bear in mind that there's a huge amount of liquidity on the sidelines that should prevent the markets from going back to the March lows. So we still see gains in equity markets over the coming years because of interest rates being very low, because of liquidity. So don't give up hope, but don't expect the markets to go up by 50% as they have in the last 6 months. I think going forward, it is going to be a choppy ride. It's going to be slower gains, but I think there's still gains to be had, given low interest rates, given liquidity, as long as we don't have any big surprises in terms of financial crisis or a big fallout in the economy. So with that, I thank you, and I pass you back to Mervyn, for him to take over.